everyone, welcome to Fearfully Greedy. In today's episode, I will go over the Hindenburg research short position, like kind of the research that they did on Carvana, and see what I think. See if I should sell my shares or not. Everything in red I added, okay, so it's not their thing. And yeah, to start off. At the start, there's like these highlights from the entire document. I would say that it would be very nice of them that they should put their disclaimer on top before saying anything about the stock, because this Hindenburg is a research kind of firm that what they do is they short position, and most of their gain is on the news. Like what they do is they put a short position, they post this kind of report, and then the stock moves down 10, 20, 30%. They cover. That's good. Okay, so we'll see if I have to sell my shares or not. And I added some of my research quickly because they say it took them a few months to do this, and they probably had to pay a lot of people to do all the interviews. I spent nothing, and I went on first principles, just trying to see if what they say is true or not, or if I agree or not. Okay, here we have the disclosure. Okay, after extensive research, we have taken a short position in the shares of Carvana, New York Stock Exchange CBNA. This report represents our opinion, and we encourage every reader to do their own due diligence. Please see our full disclaimer at the bottom of the report. Okay. Well, here they just do kind of a bit of background on Carvana. It's a 44 billion online car dealer, headquartered in Tempe. I wouldn't describe it exactly as that, but sure. It's not 44 billion anymore. It's 36 billion, thanks to you. But okay, let's move on. Let's move on. The main business is their online platform, which accounts for 70% of their total revenue. They also do financing, insurance, and other kind of protection plans like any other used car seller dealer. They also have ADESA, which is kind of the wholesale, and registered auto dealers can sell in these auctions or buy from ADESA. They spun out of Drive Time, which this is important. Okay, Carvana originally spun out of Drive Time, which was Ernest Garcia III is the son of the owner of Drive Time, which is Ernest Garcia II. The Garcias were billionaires before starting Carvana. That should be a big thing, okay? And they will go also a bit on the background or of the Garcias, okay? But Carvana spun out of Drive Time, okay? So initially it was in one of the companies from Ernest Garcia Sr., okay? The bull case, okay, is that the US used car industry is projected to reach 600 billion in 2024, but remains very fragmented. So a lot of mom and pop dealers, like they have a couple lots and that's it. And the biggest group has maybe, I don't know, what is this? It's like 2%, 5% market share. So it's super disregarded, and what Carvana does is they create this website and they have these logistics involved and they start to cover the entire nation. Okay, Carvana prides itself on a simple, seamless, differentiated used car buying experience. I would say it's not that Carvana does. If you see anything online, their platform, you have to use their service or you kind of do any of public client how they say, like interviews, like a bit of polling data, you will see that mostly people are very happy with Carvana. We have compared to the second best, like CarMax. Well, I have just some of the reviews of the apps and platforms and everything, and clearly it's much higher than the best, right? Considering to the public, to the user of this experience, you should have probably interviewed, I don't know, more people that use the platform, just not previous execs, like not bitter people that are not in the company anymore. But okay, there were in September 2023 there were fears of bankruptcy. They kind of restructured it and slashed 1.3 billion of debt, and they started a 3-step plan, which was like to cut costs, become leaner, just have good profitability metrics on a per unit, like they use a lot of gross profit per unit, and then get back to growth and grow very much, right? Kind of the three-step plan, okay? This GPU is 54% higher than competitor CarMax, and if we go by EBITDA, that's also much higher, okay? But you pick GPU because you will say that GPU is not real and whatever. Okay, Carvana share price rocketed up over 284% in 2024. Investors believe that their company's worst days are behind them. Okay, this is for the bullish part. Okay, let's take fundamentals. Okay, Carvana trades at 845% higher sales multiple than online car peers like CarMax and AutoNation, and 754% premium on forward earnings basis. Okay, we did price to sell, and this is the kind of graph. Okay, what I would say is that sure, you can compare them to these companies, but let's grab the best in the sector, like, which is CarMax. Everyone knows, right? Let's see their gross margin. Since 2020, as they have grown units, as revenues have been growing, their margins have become worse and worse and worse, and kind of negative on operating. Okay, if we see that the story here is that they have a different model that allows them to, as they scale units, the variable cost becomes, the fixed cost becomes smaller, so on a unit basis it becomes better, and eventually once the right units are there and they have the right numbers, it becomes better. I think this graph looks very different than this graph, but of course the units here are much lower than here. But if we see on the last quarters, they have reported best EBITDA per unit, best GPU per unit, historical levels mostly, so better than ever we have seen anywhere else. He also says that the rating by the agencies is very bad. These extremely optimistic valuation multiples appear to factor in high probability of continued growth that will result in vast runaway profitability. So that's still the bulk case. Okay, Carvana valuation also seems to take for granted that the company can overcome its current debt burden. Carvana has the lowest credit rating amongst its peers, by minus, which is junk, across, per Bloomberg. Okay, the company remains significantly indebted with net debt close to 5 billion. Okay, 4.4 last 12 months adjusted EBITDA. Well, you adjusted. I did not. Okay, but if we take your same peers, okay, exact same peers, who is more leverage? Who is more leverage? Like, are these numbers wrong? Who is more leverage? Caravan is the least leverage company. Okay, they are coming from a very bad EBITDA, and the current EBITDA is the best they have ever had. But if we talk about debt, maybe we should do debt to revenue if that makes you happier. But the idea is that on the last quarters, as they have turned like kind of a, as you say, like the profitability switch. On the last quarter, we had 147 million on EBIT, which will more than cover, if we annualize that, the next year cash interest, and probably if things go right, I mean, we're always playing into the future. Like, if things go right, of course. Like, if things go wrong, we'll face a bit of other problems. But okay, yeah, the idea is that with just half the year they can pay for this interest, right? Okay, fundamentals. Carvana's business is highly cyclical and faces major headwinds. Subprime auto loan delinquencies are higher than during 2007-2008 great global financial crisis. Used vehicle prices have declined 20.3% in the past 3 years, according to Manheim Price Index. The auto industry is highly cyclical, right? They include it in their risk factors. Well, if you read a few 10Ks, you will see in risk factors they have to add anything and everything. Like, it's sure, like if used car price go to zero, well, yeah, you are broke. But okay, heading into 2025, signs of stress are increasingly evident in the US auto loan market. Subprime auto loan delinquencies are currently higher than during the global financial crisis in 2007, 2008. Okay, so subprime auto loan delinquencies are high, and a lot of lenders have pulled away. This will be important later, but remember that, okay? Yeah, highest, well, I mean, they are some of the highest, right? But it's not the highest ever. Approximately 44% of the cars fined since 2022 are underwater, meaning they are in negative equity per report by Car Edge in December 2024. As detailed later, Carvana has heavily focused in its operations on the risky subprime, deep subprime, consumer most impacted by this problem. But I will say that this number, which is this article here, which says 39%, if you click here, this comes out, but probably it's another metric probably, and electric vehicles are the highest, which is not the highest in Carvana. And also you have forgot to mention, which maybe I'm wrong. If I'm wrong, please comment on the video, tell me I'm wrong, but this is mostly for new cars. Carvana doesn't sell new cars yet, but it's for new cars. Negative equity in used cars might be negative for a few months, but then it's not anymore. The market has to move widely to make that negative equity, like if you know a bit the math. So I don't think it makes, yeah, like your point stays, like I'm sure you want to be a bit inflammatory here and say that negative equity is super big, but yeah, the people that have less money are more affected by negative equity, and they probably finance very badly, but mostly it's for new cars, which Carvana doesn't play in. Since this is the used vehicle value index, but Mayhem, we have used it in a few of my videos when covering Carvana, so they tracked a bit on the average price of vehicle, right? So it tells how expensive or cheap used vehicle is. Since Carvana announced its February 2023, three-step plan prices have fallen 12.4%. Lower prices generally have negative impact on gross profit, as the number is smaller, some percentage, well, it should be smaller. On percentage, as some fixed costs of fixing a car are the same, so the margin should compress, right? Okay, agreed. But it's 12.4% in 23 months. Okay, do you know how long cars in Carvana at the moment sit in a lot? Well, for a good thing, we have Sky Holman, who posted in LinkedIn saying that Carvana inventory report car is some of the best in the segment. Car match is even higher. Depends on the month you check, they are back and forth, but clearly both are doing great things. Do you see here? Average days on lot, 26. Okay. What does it mean is that, okay, in 23 months, 12.4%. But their cars, on average, at the moment, sit in a lot less than a month. So what's this percentage in a specific car? You will say that, yeah, their margins, since they acquired them lower, they should price them lower, so margins get compressed, but yeah, you buy cheaper and sell cheaper also. So they should slightly compress, sure. Not if your other costs go down way more than this slight percentage on every sell, okay? And you call that this was magic. I like to believe. So if there's magic, I'm for it. Where were you in Q2 22, Q3 23? Because you say that despite accelerating signs of stress, Carvana profitability metrics have all improved. Well, that's in the very last quarters. If you were here on these quarters when units started to move south, their profitability was not great. Like they were losing a lot of money, as you stated. Okay, so I think you're picking on two sides. The year-over-year increase in retail GPU was primarily driven by higher spreads between wholesale and retail markets. So you forgot to mention that there's a dynamic where retail and wholesale, there are two ways that you can sell a car, and it's not just buying from retail selling to retail, which Carvana does. Mostly it's buying from wholesale and then selling to retail, which is, well, I won't say it's mostly, but big part. Okay, so that dynamic you have not mentioned, and we should see also like the wholesale graph here to also kind of make sense of it, because in some quarters it moved a lot and it helped a lot. Lower retail depreciation rates, lower average days to sell, this from Carvana, and reductions in reconditioning and in bond transport costs. The sequential increase in retail GPU was primarily driven by reductions in reconditioning and in bond transport costs, which we will talk in a second. And while Carvana client profitability has not reflected these pressures, well, if you say so, other reported Carvana metrics are not immune to this cyclicality. Carvana quarterly sales still have not reached peak levels seen about 2.5 or 3 years ago. Yeah, they have not. So the revenue went down, their profitability up, so you say that's for sure something that shouldn't happen. Carvana CEO Ernest Garcia III, father Ernest Garcia II, sold 3.6 billion in Carvana stock between August 2020 and August 2021. In the year after he stopped selling, Carvana stock plunged 99% within 16 months. Carvana was facing bankruptcy concerns. The Garcia knew it was short-lived. The Garcia knew the music will eventually end. It's funny that you bring this quote here. Funny, because this is from when Carvana fell, like the first time when it fell to from 300 something to $4 even, and that's when these posts were happening, right? But since it's moved back to 2000 200 something, right? So yeah, it's good to bring it back, but it's not from the recent move, right? So he said, well, the music stopped once, so maybe it stops again. That's your thing. Okay. Between August 2020 and August 2021, Ernest Garcia Sr. sold 3.6 billion in Carvana stock per Bloomberg. Our result relative to and this was August 2021. As his sales were concluding, the company was touting a bright future. Okay, so they say that they pumped the stock up to sell a lot, and then it fell because you think that then they sold all the shares and then they stopped losing money. I just want to point something. Ernest Garcia Sr. is almost 70 years old. He was a billionaire before Carvana and will be after Carvana. So yeah, he sold 3.6 billion shares at the time, which were still lower to that valuation. So probably he was close to 2 billion invested in the company at the time, 20 billion invested in the company. So selling 20% down from a company which he's just an investor at this point, or his role now after moving from drive time and just Carvana trying to go its own way, it's just as an investor. And I think just unloading when you have 20 billions into stock, which is, well, be honest, like could not work. Like debt was high, and I don't see it like wouldn't you do the same? I would do the same. So I wouldn't want to have my entire net worth, which I think he also has other money, but my big part of my net worth just linked there when they probably doesn't need it. Maybe also it's good because you later you mentioned maybe having capital raises. A way to do that maybe is sell some stock when you think it has moved a bit up, so we have some cash if bad times come. So I don't know. I don't think it's the worst thing ever. I don't think they pumped it just to sell the stock. Like, this is a big stretch. Carvana rapidly turned loss-making, swinging from net income of 45 million into net loss of 68 million on that quarter. The company then reported 7 consecutive quarter losses, totaling a loss of 3.5 billion. Yeah, fun times. Yeah, and yeah, he sold on the last. Well, it went down to 3.5 dollars the stock from 357, which was probably the highest he sold. That's pretty much my reasoning behind his sales. He has kept selling, like after the stock, like he wouldn't sell at 3. Like, do you want him to sell at 3? I think he wants to unload because his function in the company as an investor is pretty much set. Like, if he could shed a bit of ownership and just be a bit more relaxed and out of the scope of being like fully owned by him, I think that's what he wants. Okay, within 16 months, the CEO of Father ending his billions of dollars in share sales, the company was facing bankruptcy concerns. Okay, we have covered this. What I'm saying is that Garcia's knew it was short-lived. Okay, again, like first in bold, big title, a comment more than 2 years ago on a previous decline of the stock, and when it's going high, you bring it again, just to try to bring it down. Because to be honest, you probably have already, well, you guys have probably already covered your short. Since 2023, the same trend has restarted. Carvana has touted a bright future and posted 3 consecutive quarters of positive net income in aggregate of 245 million. And you know what? More is coming. More is coming. So I would cover. Like, I wouldn't keep this short up. That's my non-financial recommendation. Remember, I'm not giving financial advice. Okay, I don't want to be liable for everything. Um, so I'm just giving you some information, just giving my comments on the stock. For every $1 in net income it generated, the company added 139 million in market cap, representing 34 billion in market cap increase. Do you know how many companies without net income they raise so many billions? Like, if that's the point, sure. Shares are up 42 times. Ernest Garcia has sold another 1.4 billion. Okay, the same pattern of results. They have better results and they talk about them because they have the best results across the industry at the moment. So we keep marching and we will. The goal is going for millions of cars in the future. They have never said they didn't, even when the stock was down a lot. And it's still the plan. Over the last 2 years since its restructuring, Carvana has simply flipped a profitably switch. Okay, think about the switch because it's important. Maybe at some point we need to turn the switch on just to bring the profitability up. The company's net income margin went from -15% to 4%. So -15 to 4% very quickly. Also here, yeah, so these are years. Yeah, that's correct. By reporting just 245 million in net income in the past 3 quarters, Carvana's stock added 34 billion in market cap, or $139 in market cap for every $1 in net income. Well, I can give you many examples of people pre-revenues, pre-profit, just giving a bright future forward. Wall Street analysts have celebrated and say that the worst is behind us, and the stock goes up to 184% until you posted this. And once again, despite his son's optimism and the company's recent positive metrics, Ernest Garcia II has aggressively sold stock. He dumped 1.4 billion in Carvana stock. Okay, I do think that he wants out of the company and that it makes sense. Okay, I don't know how you would go about it. Should he have waited until it was $3 and unload all of it there? That would make it better. I don't know what's your point. Like, he wants out. At least big unloading of, like, he has a lot of money there. Like, if you had 20 billion invested in a company, I would like to see how you react as it goes up. During this time period, only one insider bought, which was a broadman Neg Parik, who bought 2,600 shares. Like, no one else is buying, it's only options. Okay, that doesn't tell me much. Okay, let's see your research, please. Solvency risk. Despite the market optimism, investors seem to underappreciate the Carvana's business is capital intensive and reliant on the willingness of third parties to purchase the loans it originates. I would say that that's like every other used or new car retailer, like any dealer. Do you think they keep them in their books, every dealer, in every lot? Like, that's not special about Carvana. Who in the world keeps the loans in the books? Well, CarMax does a bit because they have a finance kind of department, which I think captive lenders, even in dealers, is not the best idea in the world. Like, if you think shady things happen and interests are not aligned when you have to deal with third party, imagine inside the company. That's why they tend to be spun off, but sure. Okay, Carvana relies on third-party financiers to purchase the auto loans it originates. Over the last 9 months, Carvana sold 6.15 billion in loan for a gain of 541 million, a metric representing 2.2 times net income in the period. It's actually more of a subprime finance business than it is a car dealership. Former Carvana director. Should you disclose if these people spoke to you in interviews for commission? I don't know, just asking. Rather than keep the loans on its balance sheet, Carvana offloads the vast majority of third-party buyers. You will also see that later they say that we think that they sell every loan, but they keep some on the balance sheet, so you push them for not keeping them on the balance sheet, and later you will say that they keep too much on the balance sheet, which it just, I don't know. It's nice. It's nice to see. Same title as before, 36% of gross profits over the last 9 months. For further comparison, the metric represented 2.2 Carvana's net income in the period. Okay, I would like to show you here this from Lithia. And if you see, these are revenues, this gross profit, 27 billion of revenues, 4 billion of gross profit. You want to see finance and insurance, this to this, it's also 25%. Also 2 times net income. Do you think it's crazy? Like, most car companies, most dealers make a lot more margin on finance and insurance than in anything else. So I don't think a 10% gain on the selling of the loans is crazy numbers. Okay, here we have CarMax auto finance income, which 9 months ended November 30, 2024 was 422 million. Okay, if we go to net diluted earnings for the 9 months, it's 410. So 100% of net income is the auto finance income. Like, I don't know what your point is. Driveway Finance Corporation originated 518 million in loans for a total portfolio of 3.8 billion, priced at 615 million, which is kind of a normal gain. And this is Lithia also. So it's kind of a normal margin. Like, I don't know what's your point. Do you have a point? Is there some research here that we have not seen? Because to now is a nothing sandwich. Carvana has replied on a purchase commitment agreement with Ally Financial, to which it sold 3.6 billion of vehicle loans in 2023. 60% of its total originations were from Ally. Since 2021, Carvana loan sales to Ally have increased substantially relative to the amount of loan it originates, from 29% to 60%. I think in 2024 it's lower, but sure. 3.6 billion loans to Ally Financial. Okay. I think this has more to do that the subprime or the most distressed auto loans, a lot of players have pulled back. Like, this is just a Google search, but T-Bank has pulled back on auto lending, upgraded sites on auto loans as legacy banks pull back, so legacy banks are pulling back. Car loans are getting harder to get as lenders turn cautious. Everyone was trying to not finance these loans, so they had to rely more on Ally, which still wanted some of it. Which I think if a third party wants some of your business, it's for some reason. It's not because they want to give money to Carvana. In November 2018, a Bank of America analyst asked Carvana leadership about diversifying away from its relationship with Ally. Carvana CEO Ernest Garcia answered, "We'll probably continue to develop more of these financial buyers over time. Over the next several quarters, we should find someone else. I think that's an opportunity for us. I do think there could be opportunities to expand the set of partners over time," in another meeting. However, in the more than 6 years since that initial question, Carvana hasn't announced additional banking partners and has actually increased its concentration with Ally, as noted in the previous section. I'd say this has more to do with that subprime auto lending has been a hard market than anything to do with Carvana specifically. Carvana calling off an earlier agreement in principle with Wells Fargo. Who? Okay, so Wells Fargo was trying to find an agreement with Carvana. As we dug into it, the more we learned, the less we liked about it. Okay, there were lots of conversations, but always roadblocks. Okay, Wells Fargo senior manager said, as we dug into it, the more we learned, the less we liked about it. Their underwriting practices were not something that we were particularly comfortable with. Okay, that's from same thing. Okay, the manager also said that to say you work for a large company, you pay stub. So they find a document, a pay stub, and it didn't look very official, which we don't see the document, and they just have not provided just the words from someone. It should have a little more substance to it and look more official. Anecdotal example. I would say this is accurate. This part is accurate. Anecdotal example. Another deal breaker was that they wanted to, if they are a service member that has a complaint about their rate or repossession, of their claiming any sort of concern that would run as a foul or of regulatory expectations, and so that was a deal breaker for us. So what it says is that Carvana just wants to be the one really interacting with customers, really putting the service themselves and being able to talk with to bring a better service. And for that it was a deal breaker. Like, there's been a lot of conversation, but always roadblocks, as we have heard. Okay, I would say this is another sandwich of nothing. Like, there was a Word document that didn't look official in one of the pay stubs. Okay, the more we dig, the less we found, the less we liked. Okay, as the subprime auto loan market declines, Ali has amended its arrangement with Carvana 5 times in the last 2 years. Well, every one of these amendments is to change the dates of the agreements, to change the number, so the amount, and also to change kind of the risk, the loan to value, the size of the loans, that kind of the FICO scores, those kind of things. They have to make an amendment every time. I think 5 times in 2 years, when you're buying $4 billion of auto loans in a distressed market, just when you want to adjust something, is not a lot of changes. I would change it more, probably. Like, I've not made a loan to anyone ever, but I would probably change it more if it's 4 billion, right? In February 2023, CEO told investors that they couldn't be happier with the Ally relationship. However, after 5 amendments with Ally since 2022, and Ally's deteriorating credit metrics across its portfolio suggests that while Carvana may be happy, Ally likely isn't. Okay, so this goes this way. Okay, every quarter, tier 1 up, total capital ratio up, CET1 ratio up. Dude, like, deteriorating credit metrics. Like, have you brought any proof? I don't know. Like, again, like an interview with someone, or just speculation. Like, this pure speculation. Okay, over the last 2 years, Ally's loan book has become increasingly concentrated, with Carvana loan raising from 5% to 8.54%. I think they like the loans. I don't know why they would do it if not. Like, because they cannot find other people doing loans? I don't think that's the case. I will make a point a bit more south. In September 2024, Ally stock fell 20% after warning investors on the retail auto side or credit challenges have intensified. So it grew from 5% to 8.5% for the Carvana share. Unexpected surge in delinquencies. This is across the entire sector. On the retail auto side, okay, challenges have intensified. Okay, I reports on expert. Okay, we have already seen this. Okay, sales to Ally have been significantly scaled back year to date through September 2024. Carvana sold 2.15 billion of auto loans to Ally in the period, only 35% of total loan originations compared to 60% in 2023. The sales to Ally seem to have slowed down. Yes, we already read this. Why you put a title that is longer than the entire thing? I don't like that. Okay, delinquency rates. This from Ally. Okay, we have seen that consumer banking 30 plus days, so 31 day from Q3 2023 to Q3 2024 have moved from 564 to 561, and it peaked in 2023 Q4 634. I mean, if they said it, maybe you say that the scaling back has pushed this again back, but it's quarter to quarter. Like, I don't. Okay, we have pulled back from Carvana pretty significantly in 2024. We'll like to read the entire comment because I think there's more color there. Ally's commitment to purchase from Carvana extends only to January 10, 2024, posing a near-term risk to the Carvana model. Okay, they have pulled significantly. A lot of it has to do with our own capital and liquidity and performance of some of those older vintages that have been underperforming. We would like to keep, well, but right now we're buying a little bit to keep the relationship there, keep the relationship strong. That doesn't seem like someone that just want to say forget about it. I think there's been some stress in the system. They had some liquidity concerns and they pulled a bit back. Do you think it's like Carvana specific? I don't see it anywhere there, here. Okay, when they ask that executive if they would buy deep subprime origination from Carvana, we ask if they would touch loans so low as this. We don't go down there. So probably they sell to someone else those loans. As part of this latest amendment agreement, Ally committed to purchase 4 billion only to January 2025. Well, I have some news. On January 3rd, 2025, they have established, did another amendment pushing the date for 2026 until 2nd of 2026 again to 4 billion. So I think this point is settled. Okay, let's keep going. With Ally quietly pulling back in Q2, Q3 2024, Carvana sold 800 million in receivables to a new unnamed buyer, which it claims is an unrelated party. Okay. During the 3 and 9 months ended September 30, 2024, they sold 0.4 billion, 0.8 billion to unrelated third party on terms substantially similar to the company's securitization transactions and sales under the MPSA Ally. The new purchase accounted for 18.3 and 16.3% of Carvana's total finance receivables sales in Q2 and Q3. Okay, so they seem they found someone else. What is this kind of sell is instead of a forward flow like the MPSA deal, it's more fixed, it's a one time, tends to be a bit more favorable, typically higher on debt advance rate, and typically lower on spread between debt interest and common benchmarks. So with Ally, they have the MPSA and wall loan sales to a trust under a master transfer agreement. Both the channels represent forward flow commitments to purchase of loans from Carvana on an ongoing basis. But now they have this fixed pool, and this is dating this from 2016 or something like this. So, oh no, 2019 I think. So it's nothing new. They have done this before. So let's see the point. Okay, so the buyer is likely a trust affiliated with Cerberus Capital. Carvana director Dan Quayle is Cerberus chairman of Global Investments, indicating the new buyer is an undisclosed related party. So your point is that it was a related party. A related party transaction is conducted between two parties that have a pre-existing business relationship. So would it really Yeah, there might be some conflict of interest. So maybe yes, so they should relate it to a related party. But I'm not, so I cannot say either way, like if it's one thing or the other, really. So there were two trusts, Toad Point Auto, which were they were formed. So they were here. We have some evidence that they were created on the same date. Yeah, so they were formed matching the dates here, matching the dates of the Carvana fillings. Okay, so they were formed on the same dates. So yeah, I will say it's probably true. Corporate records from the state of Maryland show that the principal offices of both Toad Pointers are in the same headquarters as Cerberus Capital Management, a large name brand asset manager, which is what Carvana said. Like it was a large name asset manager. Okay, okay. Several registered, so it's from them. Okay, you proved it. While Carvana explicitly claims in filings that the new buyer of its fixed poles is an unrelated third party, one of Carvana's long-standing director Dan Quayle. So you're saying the same thing again. Well, I will also say that it's important to mention that Dan Quayle was the vice president of the United States. Like he was the vice president to George Bush, the 44th vice president of the United States. So he was a vice president. So I think that's very important also to say. Notably, despite not selling a single share since Carvana IPO, Dan Quayle sold almost half of its Carvana holdings in May 2024, uh, closing to a total of 3 million. Okay, you imply that he saw what the loans were and he didn't like the loans and then he sold, or since he sold, he unloaded the receivables, then Carvana stock would pump because of that. Like I'm not exactly sure what you imply. You imply that it's a related party and that Cerberus is probably doing better terms than someone else, or your thing is that they say it's unrelated and it might be like related. I don't know enough to say. Like I don't know if this makes a related party. Okay. Okay. Carvana's lax underwriting has resulted in an uniquely toxic portfolio in an industry already facing stress, threatening its entire business model. Straining its financial prospects, Carvana loan portfolio is showing signs of being highly troubled in an industry already facing major economic headwinds. Carvana's originate to sell model is highly skewed to packaging non-prime and subprime borrower loans. Well, that's their segment, so it's who they sell to. I don't think the model is much different than what we saw kind of early 2000 mortgage-backed securities. Former Carvana director. Okay, large institutional trader. When asked who is buying subprime auto paper, I wouldn't even call them flippers. They are just morons. Okay. Carvana has very few restrictions on lending, merely requiring that a loan applicant has annual income of $5,100 and be over 18 and have no active bankruptcies. When they would, so a former marketing head of Carvana, marketing head, okay, when they would talk about SEM, search engine marketing keywords that they were using, one of the most expensive but highest return on investment area was low credit, bad credit, auto loan. If you look at their general marketing, nowhere does it say that it is generally great for people with subprime credit. But that is, I think, behind the scenes, they are doing a lot to push that market. Because auto loans to low credit and bad credit are higher margin, they are higher risk, but they are also higher margin. They are probably also more underserved. More generally, more people on that segment would buy with their phone. But there's other things here. Former finance director went on the characterization the type of customer as the sort of people that may get turned down from a different dealership or get quoted unreasonable down payment. Okay. Former finance director of Carvana? Okay, we don't know. As an executive at closest competitor, CarMax told us Carvana's business was becoming ever more like its CEO's father subprime car dealership, DriveTime. DriveTime specializes in providing finance to subprime and non-credit customers. Isn't DriveTime their loan servicer still? Doesn't it make sense that that's the case? They are specialized in subprime and non-credit customers. Also, do you remember that Carvana spun out of DriveTime? So it doesn't make sense that their know-how, their bread and butter is subprime and no credit customers, and they know how to make money there. Well, really, what Carvana is evolving is the online version of DriveTime. Ernest Garcia III. This is going to be the online DriveTime called Carvana. Okay, that's by CarMax, executive at CarMax. Okay. Carvana is largely going to do the same thing, target the distressed consumer with a lower price vehicle that's not quite up to date, up to adequate standards of quality, and make it an easy process. Okay, I hope you back this up, like quite up, not quite up to adequate standards of quality. Based on what? Okay, based on nothing again. Okay, well, Carvana certified vehicles, which is kind of a segment of their vehicles, they undergo 150-point inspection process to ensure they meet our strict mechanical, cosmetic, and safety standard. This inspection includes an assessment on their tires, brakes, other wearable parts. Any component that does not meet our quality standard is either replaced or repaired. Do you remember their inventory card way up? That it was the highest in the sector, like in depreciation, in kind of valuation, like in many metrics. Do you think it's a substandard subset of cars? Well, I also like that you base it on nothing. This is a quote also from CarMax executive. But if this is someone that says this based on nothing, just because it's a competitor, okay. Okay, almost 44% of the 6.8 billion of Carvana receivables trust loans itself into asset-backed securities deals are non-prime, with average weight FICO score ranging from 567 to 584. That's 44%. Shouldn't we average all of them? So these serve they serve like someone with very low FICO scores, which I'm sure in this range of FICO scores there's very different people. Like if we meet 10 people with these scores, there's someone doing great things, there's someone maybe not doing the best financial things either. But it's their niche, plus their know-how from Dive Time and Ernest Garcia Sr. Like, it's what they know. Like, okay. Given that 9 out of 11 of the above tranches have weighted average FICO scores, remember this is 44%. So it's not the 100% of the loans. But of these that are subprime, of that 44%, 9 of 11 are scores below 580, making it deep subprime and subprime. Okay. It's a matter of rate and pricing in the end. So I think it's a matter of rate and pricing in the end. Okay, you can have more losses because people have worse credit, but if you charge enough on top, you can still make money. What would you prefer? That these people don't have access to cars? That's better. So I think they are doing a great service. Like I don't know why. I would like to see the final results of all these tranches, because sure there will be more delinquencies, sure there will be more net losses, but the total, so the arrangement of the loan doesn't make sense, like the final numbers. That's what we should be checking, not just delinquencies. If the bank partners wouldn't make money on the loans, they would just stop buying from them and not renew. You think Ally or other parties, related or unrelated, are an NGO to Carvana? Do you think they just pour money there because that's to pump up the stock for someone else? Like, I don't see the relationship. Like, I don't see. So your point is that their loans have more, they are more risky. which I will agree. I don't think the model is much different than what we saw. Okay, we saw that before. The funny thing is that the people buying this are, I wouldn't call them flippers. They are just morons. Like, they don't do any work. They just say, oh my god, the hot market, let me buy a big sandwich of nothing. Thank you. We actually approved 100% of the applicants. Okay, get it approved in 2 minutes. So 99% of customers that apply approved. Spoke a former director of Carvana, former again. Like, if people are under 18, you can give them a loan no matter what. Various other stuff like that. We actually approved 100% of the applicants we didn't decline for compliance reasons. And the way we manage risk was through down payment. This is strategy, so I'm not saying it's good or bad, I don't know enough to say. But managing the risk through down payment, people who can pay enough in the down payment. So banks do it maybe a bit different, less front payment, more, I don't know, margin, more rate. So they say they are probably more risk tolerant. Okay. Okay, so let's keep going. Carvana has issued over 15.4 billion of asset-backed securities, which retains partial interest on in its balance sheet. 60-day delinquencies, 60-day across its supposedly prime borrowers are 4 times industry average. Former Ally Financial didn't like the numbers. Well, same things. Carvana had issued over 15.4 billion on asset-backed securities, which it keeps at least 5% interest in variable entities in its balance sheet. There's a trust report, and these numbers are from the trust report from December 2021 to September 2024. It has moved from 5.13% to 8.67%. Okay, what I did is to compare. I grabbed some numbers from Lithia. Okay, Lithia does kind of a similar thing, also selling asset-backed securities and having a trust. So 60-day plus, close to 1.3, it's 397, 3 times more, 3.5 times more, so not that far off. And these are the delinquency ratios of, yeah, we don't have exactly the same kind of breakdown. But if you see on the after 50 months, the total delinquency ratio, which is 31 days plus, 31 days plus is 8.7%. It's not that far off, maybe double. Yeah, we could say that double. Double is a lot, right? It's a lot more. But I will also point at something that here we have the, yeah, kind of the pool that they hold in the balance sheet. I don't know exactly because I saw that the weight average FICO score is 700. So I don't know if they keep better ones for them. Not exactly sure if that's correct, but well, weight average APR, it's 13% here. Weight average APR for Lithia is way lower. So that difference can make up for the higher delinquencies. So that's what I mean, if having higher delinquencies but you charge more, it makes sense. So it's always a risk and a price, and for a risk you take, you will need more price to cover, and that's pretty much the entire thing. Yeah, Ali Financial didn't like the numbers. He says they're a bit high, but yeah, if you're charging more, I don't know if we take that into account. Carvana subprime loans had the highest increase in extensions of any subprime auto issuer, a major sign of stress per the most recent S&P data. I will also say that if you see finance receivables, if we compare to end of last year to September, someone is buying them. Like, maybe it's a related party. If you say like people are putting money for fun, sure, but someone is buying them, and that was like 16%. So someone is taking 80% plus of those loans. So they must be not that bad. Here, the extension, so they went from 1.97% to 4.18%, more than doubling for Carvana. So okay, let's go to that there in a second. So 197 to 418, but if you take another quarter, it was 364 to 418. So you picked a specific quarter because it was the lowest, and then you picked the highest because it's the last one. Yeah, you could have taken September 22. Also, 418 to 344, which is the average. Is that very far off? 364, 304, like there's not much. There's not much here. I don't see. You picked a specific number for fun because you thought it made sense. Like, why you specifically pick this period for fun, right? Okay. The next largest loan extender by percentage in the S&P universe is drive time. So, Ernest Garcia seniors. But doesn't it make sense? They are their loan servicer. They are who really is taking charge of this loan. So I don't think there's much here. I think it makes sense. I would also here I put like losses. So these like cumulative static net losses for Carvana. Let's take the highest we can. Okay, probably this is the highest. 2022. It's 2.11, so 2.1% in the 26 period. It was 2022 third period, third on the 26th. It's the same. It's the same. Like, I don't know, when you go out of your way and you make a report, you should have like better numbers, not just that these numbers look very different. But if you take another period, they don't. Also, is it just Carvana subprime or is Carvana overall? Because I don't know why it takes because it's only non-prime subprime, so they kind of parse it. Okay, if we go to this from Lithia, they're expected, so this is like expected net losses like this, but expected at the end of the entire thing, it's close to 5%, which I don't know, they are 70 months. Do you think it will get there? Maybe. I don't know. I don't know if at the end they pick up or not, but I don't think you have strong data to say everything you're saying. Like, it's a bit of a stretch. The subprime issuers that saw significant increases year over year in extensions were Carvana Subprime and Drive Time Automotive. And I would like to see total data, like because Carvana has they are more focused on the deepest subprime, like it's like their specialty, like different loan service, like if you get a loan but you are a more risky borrower, they would charge you more, but in a sense, if it makes sense to them, they will just price it correctly. Like I don't think we're seeing anything crazy here. Okay, why might Carvana loan servicer be granting mass extension to borrowers rather than recognizing more delinquencies? Uh, right time is so okay. Illustrate us. What solution? The lack of separation is partly why, as noted earlier, prospective financing partners like Wells Fargo backed away from working with Carvana per our interview. As Carvana loans have faced increasing stress, its related party servicer seems to have opted for granting mass extension rather than recognizing delinquencies. As we found, Carvana servicing relationship is just one of many related party accounting levers that the company seems to be using to prop up its number. You might have a point here that it makes it harder for them to find financing partners due to that, but they are manipulating the numbers to have better numbers on the asset-backed securities. That's a bit of a stretch. Like I would like to see some more data. So like you saying that they are giving more extension than everyone else, we saw that was just playing with the numbers, like grabbing the quarter that you liked instead of another, or the year that you liked instead of another one. And if you base on that they are giving more extensions to make better numbers, I think you have very weak data on that point, right? Mm, but yeah, that will probably make them have to work harder to get partners in, or maybe put some controls in place or some applications to give. So it might be harder, yeah. With its market collapsing, Carvana has propped up its numbers through a grab back of related party accounting games. Okay. The board may approve transactions only if it determines that the transaction is on terms no less favorable in aggregate than those generally available on unaffiliated third party under similar circumstances. That's what it means, is that you cannot do a related party transaction if you are benefiting the other party, right? More, because we are shareholders, so you cannot be helping your dad out, right? But if your dad wanna helps you, like, do you have a case? Like, I don't know. While this statement seems innocuous at the first read, our findings show that it has opened the door for vastly favorable related party deals that can prop up Carvana's recent financials and create the parents of growth and profitability, while allowing key insiders to dump 1.6 billion in undervalued stock, while the guy was holding 20 billion of stock. Like, really? Okay. In fiscal year 2023, 145 million of other revenues, or 8.4% of gross profit, came from related parties. This revenue is 100% gross margin because you will see it's more like a commission. But yeah, your point is that drive time should keep more of the profit. Like, mm, yeah, I don't know what you would like. Like, unreported costs of extended warranties onto related party drive time, resulting in artificially inflated revenue and profitability. Former Carvana leader told us that the warranty reimbursement from related party drive time were pretty generous back to Carvana. Pretty generous back to Carvana. So his dad is helping him out. It's helping me out too. Like, I don't know. The son has a lot of billions. They have way more invested than I do. Probably that you are short the stock, so, and he wants to help his company to sell more stock. Like, you're trying to yeah, well, okay, let's keep going. Carvana takes the commission at the time of sale, recognizing revenue immediately, and also has profit sharing agreement based on performance of the warranties. That's for vehicle service contracts. That's extended warranties. Okay, and so the company collects the retail purchase price of the BCS from its customer and remits the purchase price net of commission to drive time. So he just takes his commission and passes that to drive time directly. If the contract, like the extended warranty, performs well, they also get a bit more. And they chose, these are arm's length negotiation transactions. However, Carvana's financial statements state that the transactions with drive time are not always negotiated at arm's length. So yeah, like, they could get a worse deal out, so it's better to not take the best deal with your family. I don't know. We have not shared publicly the breakdown of attach rates or counterparty economics for any of our ancillary products. Former director at Carvana. They are going to get a higher multiple on the revenue back within Carvana versus standalone. The rates, I would say, are pretty generous in terms of the reimbursements back to Carvana post claims. So they would get more money if they did more business with someone else that probably doesn't exist. Like, they wouldn't get that business anyway. So I don't think it's that bad that they give us a bit more margin. I wouldn't also disclose it either. CarMax probably doesn't disclose it either. Lithia, I have not seen that they disclose it. Why give that information to competitors? Later, I saw that CarMax does report it sometimes, like the margin on that. But let's see how big the extended protection plans are. This is from CarMax, and extended protection plan revenues are 1.5% of revenues for the entire year of 2024 and 1.4% of revenues in 2023. And they are 1.3, 1.3, and 1.4 respectively for Carvana. So I don't think they are doing anything way out of the ordinary. Like they have smaller percentage of revenues coming from that, but these are 100% margin, where these ones are not 100% margin. But maybe they price them higher. Like, do you know? Have you done any research on that? So if you look at extended warranty and service, and you think about the fact that Ernie Garcia owns a major piece of Carvana and drive times private, so he could be taking substantial losses to prop up the stock to sell it and then drive this profit back through drive time, or just no going to the sunset and leave his son hanging. Like, think about it. Do you think this through? Like, do you know the implications of I think if you write it down, well, you did write it down, but I think if you say, okay, this person is trying to do this to this other person, and what will happen if he keeps doing that is that the other person gets screwed, which is his son, and but his son will also sell last minute, and we will all get zero, but they will lose more than just trying to make the company work. Like, I don't know. Also, with such little proof, like a former director says, terms might be pretty generous from the father's company to the son's company, which we own. It's not the other way around, which that would be fucked up. It's the other way, which can be good to us. And then current executive CarMax says that, yeah, Garcia Sr. owns the major piece and he will benefit from his stock options because they are playing with the numbers. Direct competitor says that. Okay, I'm not accusing them of anything. Says, I'm just saying that we have looked at this. This is one where we have looked at it and we can explain some of it, and we know this industry better than anybody. There's a high likelihood something is happening between the related parties. Yeah, the father is getting a better deal than you might, or that another person might. But saying that that's to prop up the stock, that's a big stretch. Because yeah, money doesn't come out of nothing, right? So eventually this will get back to you. So yeah, we say the revenues are a bit lower for Carvana, but it's 100% margin. So we should also check what's the margin for CarMax on that. Carvana reports 58% more warranty income per sale due to an overly favorable relationship. I like to see the math, so let's see if we see the math. By contrast, Carvana closest peer CarMax freely discloses these key metrics like the attachment rate and the profitability of its extended warranties. With this information, we are able to calculate the CarMax makes around $949 per unit sold on warranties. $949 per unit sold on warranties. Gross profit per retail use unit of 2,347 in line with last year. Gross profit per wholesale unit 1,064. Protection plans 563 per retail unit. I don't think they are showing the exact margin, so they are saying that the gross margin per retail unit is this, okay? But we can do some numbers. So it's 138 million gross profit on EPPs, okay? And they sold 312,000, okay? Let's do the math. That's $442 of gross profit per retail unit sold. Do you say this is per every unit that they sold EPPs to? I don't read the same. I read the quarter and I don't know exactly if they mean that. Because I think they are just doing gross profit of that segment, of that unit or of that service divided by total retail units. So I think you have absolutely nothing. I also read that you base that they sell 30%, so they sell one EPP every 3 cars, where here they sell two EPPs every 3 cars, roughly. So 30% they sell EPPs, 60% they say EPPs, and you base all of it, all of it. So a former CarMax executive who says the range should be around that, and a former Carvana director that says the range should be around that, but saying that their range is around 60%. So a competitor exec told you their competitor does half, exactly half of what they do, so they must be doing fraud. That's your reading. I did the numbers that I can do with the numbers that we know for a fact that it's signed. We don't know the names of any of these people. I don't know if they would sign this, like saying for sure that that's the case. So again, you're getting these off thin air. Like there's absolutely nothing here. I don't know. Maybe one day they report and it's actually 30, and here it's 60, and you have something. But I did some numbers, and they are roughly the same, even lower for Carvana. So I don't know what you say. Please prove me wrong. Maybe this is per unit that they sell to, and then we should know the units here, which we don't know, and then we cannot do the math. But I don't. I think this is per total retail units. I think. Maybe I'm wrong. We think the company should provide more transparency around its warranty sales and clarify its deals with drive time. Okay, maybe we can agree here. If they gave me more information, that's good. Okay. Former director told us a related party were able to kind of have an agreement that is favorable to pull as much of the profit forward. They know, so for the extended warranties. Okay, the administrator of the plan set aside reserves based on the expected claims over the life cycle of the contract. Carvana has a profit sharing agreement which entitles it to receive revenue from drive time based on performance of those warranties. If claims from customers are lower than expectations, they can share it in the profitability. Sorry. Carvana notes that consideration is recognized as revenue to the extent that it is probable that it will not result in a significant revenue reversal. So what they do is they kind of put as much of that profit at the moment of they doing the share, and if later there are adjustments, they might adjust. They dry time give you a buffer, and then everything else is they can push up front because they know that there's in effect minimal risk to them, and so as a related party we're able to kind of have an agreement that is favorable to pull as much of that profit forward. So they recognize those profits or losses, well, profits much quicker, which allows us to obviously have it upfront. Adds more value in present days versus 2, 3, 4 years down the road for that extended warranty, which might change significantly, but I guess they will adjust if later those revenues are not recognized. Also, does CarMax do it differently? So they get revenues on the EPPs. They hold them on their books, right? So they don't have a related party. I think. I don't know. Let's say they do it different, but they have it on their books. They have the revenue recognized today, so cash coming in for that extended warranty, and they don't recognize the revenue fully, so they only do partial. Do you know that for a fact? Because I think what you should have done is bring it here and say, look, CarMax does it this way, Carvana does it very different compared to other people. Also, what they would like to do is later see if those revenues are really not what they should, so they put some revenues on fraud that later they were not. But without being in the company, neither you and I, we cannot do that. So you prefer to think that it's fraud rather than them just trying to pull all the revenue at the moment and simplifying that way. Selling cars to drive time is a lever that is not talked about. It's kind of like Fight Club. There are certain things we don't talk about, and we don't talk about drive time. Former Carvana director. Okay. So they have generated 105 million revenue from selling cars wholesale to drive time in 3 years. That's 0.3% of revenues. Like, what are we talking about? Also, do you say here you will say that it's usually low margin business. Have you seen the wholesale or ADESA numbers lately? Are they also fraud? Like, dude, they do 400, 300, 500 GPU per car wholesale. Like, it's not nothing. Like, they do that kind of profit, and if they pull as many cars as you say, it's a normal margin. So again, I think you're just 105 million across 3 years. Do you know how little revenue that is to Carvana? Please make the font bigger next time, because maybe then you have a point. That's Ernest, that company, right? And it's not public. And at the end of the day, it's like if my kid has a car lot and I had a car lot and they need it, I'm going to go over and buy 1500 cars too. And you say that's happening now, or maybe something at the start that happened. Also, Carvana has mostly struggled with inventory. Maybe at the start there were a few quarters that they did have too much, but I don't know. I also do fully agree that if Ernie was an Ernest senior son, Carvana wouldn't have happened. They need so much of the initial investments and infrastructure. If that's your point, like that his partner helped out and helped us all out, investors, mm, themselves too, they are big investors in the company, but if that's your point, I agree. Like, if Ernest Senior was not an original investor and didn't bring the infrastructure at the start, we don't have Carvana. But I will fully agree. Okay. Okay. Now the sham deals. Okay. They say that sham. I read that the sham deal is a transaction that is made to mislead or deceive others. Okay. Let's go directly. One allegation is that Carvana entered into a sham-related party with DriveTime as early as 2021. As part of an alleged sham, Carvana paid DriveTime for vehicles it will sell and then remit the proceeds back to DriveTime for no economic benefit as in means of artificially boost reported sales. Okay, we'll try to go quick, but there's a few points here. Okay. Under his father and son deal, Carvana would acquire cars from DriveTime, sell the car on the website, and then pass the entire proceeds from the sale back to DriveTime, while Carvana merely acted as a DriveTime middleman or agent. So what they did is they got cars from DriveTime, sell it at the price, and forward the entire revenue through to DriveTime. Okay, they say this is like fraud. Okay. But in 2021, because this is from 2021, do you think that Carvana was selling any car at real profit? So a zero margin transaction is probably better than anything than anything they were doing. So it was probably better margin than anything else. Uh, Here it doesn't enter as if they were shipping the cars, delivering themselves, or anything, any of those things. But I think that those transactions have higher margins. And then you have a point here that says unit sales from this here at the end. You will say that unit sales from these arrangements were material as they made up over 169% of Carvana's reported sequential growth in fourth quarter 2021 and 19% of sequential growth in third quarter of 2021. But let's try to think this through, okay? But also by passing all the revenue through and getting no profit from that, they also damage their unit economics. You know that, right? But I think it damages your reported numbers per unit, but also increases your revenue, right? Of course. But you know what? They were actually selling the cars. So they really were selling the cars. Like, this is just like a sourcing of cars. So they were buying them, but they were selling it on the website for the price they were saying and serving, like, being the agent for the entire transaction. The sales were through the website to real customers. Your point is Carvana should have made a profit on these transactions. I really don't follow your logic saying that the growth comes from these deals. The sales were real. Just the sourcing of the car was from his dad's company, but probably at market prices, and they just weren't they were taking no profit. But I'm saying it's higher margin than what they were probably doing at the time. So I don't think you have anything here saying that the growth comes from these transactions when it's just the sourcing, like the sales were real. Like I'm repeating myself, but I see so little points, just very bold titles and nothing, like a big sandwich of nothing. Like I'm starving at this point. One independent member of the audit committee, Greg Sullivan, was previously suspended by the New York Stock Exchange after he sent money to Carvana CEO father in contravention of a prohibition order per legal recourse. Carvana fails to mention that Greg Sullivan was a board member, was already a member in the IPO in 2017, is a member of the audit committee, was also involved with Carvana CEO father during the scandal and resulted in a failed convention per litigation records. Do you know what? The video is becoming a bit long, and what I will say is they should have not appointed this person as audit committee member. Okay, I will give you this one. Okay, there's a long. Greg Sullivan was ignored a provision imposed by the New York Stock Exchange, so that he gave them money when he shouldn't because Garcia was a creditor. Sullivan was the employee of DriveTime, where he was president from 95 to 2004 per LinkedIn profile, good source, and then vice chairman from 2004 to 2007 per litigation records. So they were important people in DriveTime while Carvana was created. It sort of makes sense that they are there, but okay, I will agree they are not an independent member. Did they say it was an independent member? We also should check what an independent member really means. I think it's financially independent for the company, so they don't work there. But whatever, okay? Let's give you this one. So you have one on the board. They should have appointed someone else so the board is more spread and more independent. He was the director of DriveTime 2014, serving in 2017 when the IPO happened. So I think he should be there, but sure, let's give you one. I'm feeling the match is not very even at the moment. Yet Carvana's loan held on its book have increased 50%. So first you say that they sell all the loans, okay? And now you will make the argument that they are having a lot of loans for sale. So they hold too many loans on their books. As a percentage of revenues compared to 2021, it's probably has gone down. So, but okay, so now you make the opposite point to say that having them on the books is not good either. Okay, normally companies use the current expected credit loss model to record loss reserves at the time of origination. Carvana's stance is we don't hold loans, we just sell loans. Therefore, we are not going to book any loss reserves at the time of the booking because the idea is selling them quick and whoever has them, they will do that. Because if you don't do that, the volatility of the earnings just increases significantly. So they did an accounting thing to make the revenues and earnings be more constant. And they say that here it says that normally companies use this kind of model, but also companies that they sell every loan they originate, and they are accounted as loans held for sale. So it's an accounting thing that is normal and it's GAAP and it's something very normal, and they will sell all the loans. So are you really making this point? Carvana provides zero clarity around the nature of the vintage of held for sale loans. Wasn't there a trust? There was a trust, right? You told us above that the trust is there and there are numbers there. But the ones held for sale are not the trust ones. Okay, sorry, my bad. But probably it's similar to the ones that everyone is buying, right? Also, it's the one that they want to sell. So we cannot assess the risk of those loans, but we see that the balance is not going up. It's staying pretty constant, just selling a few, I don't know, what it is, like 300 every quarter, something like that, 300 million every quarter. If they end up selling them finally, does it even make a difference? My opinion is so far they have sold every bit of it, especially considering they have generated in excess of 15 billion in loans just in the asset-backed securities, and they have only 500 million sitting. Like, someone is buying them. You can make all the points you want, but someone is buying them. Okay, former executive confirmed that by holding the loan of sales over the quarterly line, okay, so they say that they are moving the loans across the quarter to generate more earnings on the quarter that they want. Okay, 1 minute you say that they have trouble selling the loans, the next you say they hold them over the quarter to move earnings forward. You are seeing how your logic doesn't add up. If they are having trouble selling the loans, do you think they will hold them over the quarter just to time the sales properly? Okay, they book the gain on sales when also on the quarter that they want to do. And here you point at the quarter that they were not selling enough. A forward Carvana executive with knowledge on the loan of sales, buy your word, so we'll take your word for it. You hold loans over the quarter to quarter, you can move very large amounts of income around a quarter to quarter. Well, if you have ever owned a business, I'm not saying it's right, but holding for some sales that you know you will do for sure for the next quarter to manage a bit income and cash and those kind of things and taxes is a pretty normal business thing. But also you have proved nothing. Like, you cannot prove this is happening. So like in Q4 2022, they undersold loans by a lot, so they originated way more loans than they sold. That's the only thing you can say, because CEO Ernest Garcia III claimed they sold slightly less than normalized volume of loans sales due to uncertainty on the securitization market. If we saw the Google, like the Google search I did, we could go over every article on it, but during those times, a lot of people was pulling back on the market. So the timing is perfectly correct. Maybe they timed it and they saw the market and they said, okay, now we can time it better. But you have zero to prove for it. So let's move on. Okay, so with the stock price depressed from the poor sales, which add up, like they make sense on the timing of the quarters that they say. 2 days later, they signed an agreement to purchase 126 million in Carvana stock. 2 days later, Carvana announced the best quarter in company history. Okay, this agreement to purchase stock, it was so they could restructure all the debt, and they wanted the Garcias to put money into the deal, so they wanted them to raise equity also, so not only the creditors, the lenders were taking the loss on just slashing the debt, and the Garcias put more more money where their mouth is, right? So they put more in stock and they would kind of provide some cash at the time, okay? And if you see a bit of the on all the listings is so and everything they say, okay? So okay, let's go over it. In July 17, 2023, the company entered in a transaction and support agreement, pursuant of which, among other things, the subject of certain conditions, the Garcia parties commit to purchase up to, so you see the wording, up to, if they wanted to put as much money as possible to make a crash gap, they wouldn't say up to, they would say the more the better, right? In satisfaction of that commitment, on August 18, 2023, the company entered into a securities purchase agreement with the Garcia parties. Okay, in aggregate, they were paying $37, right? I think that's the number you also gave, like $37 per share on converted basis. And they used the proceeds to fund the cash tender offered to purchase portion of the senior and secured loans, etc. The agreement to eliminate more than 83% of the Carvana's 2025 and 2027 unsecured notes maturities and lower the required cash. So it was a great thing for Carvana, and the creditors wanted some money also from the Garcia. Also, that investment that they did increased their position around 2.5 to 2.7%. So we're not talking about moving a lot. If they wanted to make a crash gap, okay, they can put more money in, but they can also just sell stock. Like if that's your point, they could just sell stock. Like if pump the stock, sell stock. But I think it's very clear to everyone that has followed the company that they wanted the Garcias to put some money also from themselves into the company to see that this company was not going to zero, right? Okay, without the equity pro rata commitment, the lenders wouldn't have agreed. That's my rate. Your rate is different? Sure thing. Okay, and the company kept going down to a price of $28. So I don't think it worked great if it was a quick crash grab. Okay, so for this next one, Carvana reports GPU 3497, which is a key metric tracked by investors. Carvana inflates this key metric by 34.5% by dumping an estimated 390 million of selling cost, well, into selling costs, so SG&A. So it's like on a lower line in the P&L. And so what he says is he says that these three items is what they lump into SG&A, where they should be more in GPU, like in COGS. Okay, limited warranty. So I will say dealer groups have traditionally had little shipping costs. That's for outbound logistics to customers, as they have always picked up their cars in the lots. These costs make sense to be below, as they are incurred after the purchase as a cost of sale, right? Cost of sourcing the car and having it ready for sale in inventory are recognized in COGS. You can talk about peers, but if you grab general accounting principles, this is how it's done and categorized. Okay, so they have a different model. They ship the car generally, and shouldn't, like the traditional dealers, do it different now that they are starting to ship things, because any company that ships things tends to put those costs in that line, like not the other way around. So same for title and registration. In registration, it's a cost of sale, not a cost of goods sold, in my eyes. But if you say that dealers traditionally have done it the other way, I mean, you can say like they are inflating another metric, but they also, well, what you could do is just grab EBITDA per unit, and that's it. They might say it affects margin, and that's why they account it in COGS, but I don't see it. Easy solution, just take all the costs accounted and do so add SG&A into your calculation. I did that in my original video, and I did EBITDA per unit on Carvana, and then I did, well, so this is for Carvana, this EBITDA per unit, CarMax and Carvana. If you see CarMax, okay, sorry, this is for Carvana, and this is for CarMax, okay? And if you see, as units move up, EBITDA trends up. Here, as units go up, both GPU and both EBITDA per unit are flat. So that's the thing, like their model with when they're so it's tuned for the right units, the margins are quite different. Okay, they were still negative, like this negative EBITDA, this positive GPU, they are both positive. Okay, but if you see the trend doesn't look the same. You could say that a traditional dealer also EBITDA, as they grow units from a very substandard number, it would trend up. Also, they would lose money early. But we know a lot of pop and like small dealers that it's one lot and they make money from the start. Like they don't lose money from the start. So I think it's a pretty central, like one dealer, if you add two lots with their respective reconditioning, so they are separated geographically, they have similar units. Where Carvana, as they pull some of these vertical integrated things into like one single fixing cars, one single like delivery system logistics, but an online website, no cost of sales for like transactions on salesman. That's what we say. Like that's the idea. The model, as it scales, it becomes way different margins. And you can maybe not see that. I will tell you, okay, you have done the short position now, but wait a few quarters. You will see. Okay, Carvana in 2023 told investors that its cost reduction measures had not come at the expense of quality that cars it sells, but the former Carvana recognition leader told us the company adopted a two-tier policy, so an economy line and a Carvana line. Okay. And they say that they don't do economy line and not economy line. Okay. Carvana CEO assured investors that it succeeded in implementing measures, sustained cost reduction measures without sacrificing quality, the used car market equivalent of discovering a unicorn. So this seems very technical wording for a short piece. With a lot of data to back it up. We'll see it now. I'm sure you have some data. Like you grabbed a few cars and you could say that you grabbed the car 3 years ago and car now and it's worse, right? Let's see what it is. Didn't make an adjustment on the standards. That's per former leader responsible of overseeing recognition. Former, so he hasn't like probably good interest. Brake pads, they would replace them at a certain point and they lower it to basically what the industry standard is. So that's even for the former one. He said they had better than in industry and now they have same as industry. So you know where you say here that they were just lower quality standards, right? So lower than industry. Even your the person reporting to you is not saying that. So just twisting things around another time. The economy line, for instance, you may be allowed to more dense and more low visibility below the wheel arc. Well, do you remember the raving reviews from customers and the raving reviews from also their inventory? I don't know your proof. Your proof is someone that even says that they are no lower than the standard for the sector. So, okay, this is a former director. You would never notice that these cars get a different treatment. There were a lot of unwritten policies at Carvana. You wouldn't notice that the cars were different, had different treatment. So if you wouldn't notice, mainly they are not doing a lot of engine work. Like it's just cosmetics and brake pads and tires and like wearable things. So if you couldn't tell from outside, like sure, but also I would like to see your proof. When I first got there, the vehicles that were coming in were immaculate, but once COVID hit, so we're talking 2020. I would like to see when this guy was fired. The cars were started getting look like they were out of a war zone. They were really bad. They would accept anything. But he doesn't say that they would just not change that and make them better. Also, there's like again no proof at all, right? Investing less in lower price cars doesn't seem like anything crazy, as those cars might be better at lower prices than fixing them to perfection for those customers. So someone that can pay maybe I don't know 15K, but if you fix that car to perfection instead of 15 is 17K, maybe he prefers 15K. Like, have you asked a customer? The customer is happy. Have you not seen that? The customer is happy. Customer knows better. But also, yeah, nothing to prove here. Like, someone said that during COVID they got worse cars, according to them, former employee. Dudes, bring us something. Like, do some research. Bring a car that looks bad. Like, you buy a car, it looks bad. Yeah, sell it again to them. Maybe break it up, sell it them again to them. Like, prove something. Like, there's absolutely nothing here. Mid-tier audition Grant Thornton for over 10 years, so their auditor has been for them with a long time. Grant Thornton, which has 10 plus year relationship with the company from even before going public. So you said that you prefer them to get one of the big four. That's your thing. Carvana is now the third largest US listed client by market cap for Grant Thornton. So it's not even the biggest. So you would prefer a big four because in the 2019 British Parliament Equity, Grant Thornton said, we are not doing what the market thinks. We are not looking for fraud and we are not looking at the future and we are not giving a statement that the counts are correct. We are not set up to look for fraud. That's what he said. So I found the same article, okay, and let's see how. So from this article, like it's like from the same news, all right? It's not exactly the same article because yours is behind a paywall, and this was public. But let's see what you say, okay? Same article, but there is a clear exception gap, and audit fundamentally gives a reasonable opinion of historic information and doesn't look for fraud. We are not looking for fraud or the future or giving a statement that the counts are correct. We are saying they are reasonable, we are looking in the past, and we are not set up to look for fraud. He said the expectation gap needs to be fixed, but admitted in the real world a sophisticated fraud would be difficult to pick up. Bosses at the Big Four, accountancy giants PwC, KPMG, Deloitte, Ernest Young, also told MPs on the committee that the audit quality is not good enough. So the Big Four said it's not good enough too. Okay, KPMG, like UK chairman, which is being investigated also over its auditing for another collapse, so you just pick one, but construction giant Carrie Leon said that the group's auditing needs to improve. So the Big Four also need to improve your level of public shaming for your own gain, because you made this piece just to benefit on the short position for such little substance is indeed a shame. So you bring absolutely nothing to the table, you did absolutely no research, and you just did a few interviews with bitter people. And really, even the people, like if you take the quotes, the perfect quotes from former employees, you could say what you say, or you could say what I say, but without proof, we don't know. So okay, let's move to the next one because I want to finish. Carvana is subject to an audit undisclosed SEC investigation per disclosed inside the Freedom of Information Act. We know the company stayed silent on two recent investigations, one of which is ongoing. Disclosed. Okay, so they are investigated by the SEC. Okay. In March 2020, the company disclosed that it had received a voluntary request from information from the SEC. So they did disclose it. In 2020, the related party disclosures and accounting policies and procedures for historical loan sales and refinancings. So more on the loans. One of those two remains ongoing. That means the other one is not ongoing, and if we have not heard anything, probably has been discharged. Maybe I'm wrong. Please show me it's another way, because I would like to know as an investor, sure. But if they have not publicly said, okay. Do you know how many companies are investigated by the SEC at the moment? Probably hundreds, thousands. Do you know? Do you think how many of them have publicly said? But Carvana did publicly say that they have been requested the voluntary like information and everything. So even the ones that don't say it publicly, because if you say publicly before it has been proven, who are you damaging? You're just benefiting your short, like short positions, but the investor, are you benefiting the investor? They disclose they were asked for more information, but if there nothing is proved, it's better to not say. I think like you will just make the stock move a lot without any substance. So why not wait until things are proven to be faulty, or until things are proven to be a fraud, until there's some misbehavior, until we make a conclusion? What do you think about that? I think that's the usual law system. Like you are innocent until proven guilty or something like that. So do you think that that's the usual, especially if they get discharged one and still ongoing one? Like to whose benefit to say that they are investigated by the SEC without any conclusions, even by the SEC? It only benefits you. So we just saw you're a bit. You want them to say things that have not happened yet. Okay, your conclusions is many business leaders look for win-win situations where the shareholders, partners, and everyone that creates value can then derive value from these contributions. Yeah, good leaders. Not like you. You just want to short the stock. Others treat business more parasitically, viewing every counterparty as an opportunity to extract as much as possible, leaving others to win nothing. Do you know? Did you talk about the gifts from Ernie Jr. to employees? Does that look like someone? maybe it was just to pump up the stock and be greedy too, right? You can also make your reading. Also, drive time, the Ernest Senior giving better treatment to Carvana than it would get in the public market. That's also greedy because yeah, it was to pump the stock to sell it more, but they hold billions into the stock. And sharing a lot of initial logistics for free and operations at no cost or little cost. Do you think those costs are free? Like, do you think Ernest Senior didn't pay for that, or that company, and they incurred losses for that? To whose benefit? Ask those questions, write them down. At any point in Carvana's first incredible run, the Garcia could have de-risked the balance sheet by raising significant capital and its then lofty valuations. To who does it benefit to raise capital? To investors or to lenders, to creditors? Time will tell, my friend, but although I would have preferred not to be flying so close to the sun, I would prefer not be so close to bankruptcy. I would also have not gotten that entry price. So I'm happy it happened that way. Like, but I don't think raising capital was the right thing yet. So we don't know if they never go bankrupt. It was the right call, right? If there's a fault, is on risk taking and speed. So maybe they wanted to go too hard, too fast, too quick, too leveraged. That I will agree that they maybe did that. But for own gain, I don't know. That's a stretch. Like please show us your this. They did this to do this, because if it's for the 2.5% that they sold, I would like to see you with 20 billion into a stock that is almost bankrupt and hold it. Just hold it, or maybe just buy more, right, on the free market. I would like to see you short positions after posting an inflammatory article. So I know you are not that kind of people anyway. Could have the risk of the balance sheet by raising. Okay, it's good for the lenders, not for the shareholders. Potentially dangerous cars due to cut-costing measures. Dude, you bring nothing to say that. They just, in the economy line, they lower their standards to meet the industry standards. So you cannot say this. Like this, I hope they sue you, like just to say these things without any proof. Like you can say them with a straight face with zero evidence. Well, maybe you can, like, because that's your business. We want to thank the literally dozens, okay, dozens of people who reached out to us, imploring us to look into Carvana, from the used car dealers and industry experts across the country to the average investor that sniffed out that something or many things weren't quite right. Dude, you have absolutely proved nothing. It's a whole plot of paper without anything that can hold, really. Like, go one by one, and you might have done it different, but fraud? Okay. Union Carvana has a big bullseye on its back and a history, so that's my conclusion, a history of bad press, and in some parts I will agree being too opaque and related party transaction, as well as compelling argument for evil conduct. So you knew the story would trend and that you could write it. That made you think it would be easy to write an informatory short piece with little substance, because real research, you did nothing on real research. It's pretty lazy, your points. You just need, probably you did 5 interviews for this. You took a couple months to write it down and you put a short position. You probably have already covered your short and are good to go, which, okay, my advice, remember, this is not financial advice, it's a friendly advice. If you haven't covered your short, I would cover, because you will lose money here. Okay, that's it for me. Maybe you have a different opinion on each of their points, but I think I went pretty thorough, trying to. I hope we saw some real research, like, okay, not just cherry picking some numbers like on delinquencies, but not checking APRs on the other side, like any loans for lower credit pieces, with loans to people with less money and less resources will default more, but that's why you charge more. Like, not cherry picking, not the easy number, not just bitter former employees, not just bitter competitor executive which will get their lunch eaten. CarMax will be fine. It's just the small business that they don't have the skill to compete. Well, that's it for me. It's probably a very long video, probably uninteresting to a lot of people, but well, if you like the video, if you have not subscribed and would like to see the journey, keep subscribe and well, be safe, take care, bye bye.